Hello, everyone, and welcome to the section on capital allowances in the Finance Director Update. My name is Heather Britton. I'm one of the tax directors based in the Exeter office, and I specialise in property taxation and, in particular, capital allowances that I'm going to talk to you about today. So what we're going to have a look at are some of the updates to capital allowances, as well as some of the opportunities and pitfalls. So just by way of a background, we've had a position now from a couple of years ago, post-pandemic, where some allowances called super deductions were introduced from companies in order to encourage the investment post-pandemic, but also in mind of the fact that there was due to be a change in corporation tax rates, which have now come in from April 2023. So they introduced a rate of 130% tax relief on certain forms of expenditure. So move forwards to 2023, and there were a lot of questions about what was going to be done when these rules were withdrawn, and they brought in full expenses. So that effectively gives a similar economic result to companies buying certain plant and machinery, and the existing 50% first year allowances would also continue. So we now have certainty for the next 3 years, provided the rules aren't changed again, as to what the landscape looks like for capital allowances. I also wanted to have an opportunity to update you and remind you about the important structures and buildings allowance to make sure that your tax relief is maximised, and also look at opportunities and some pitfalls. So to start off with, we have had the full expensing regime for capital allowance now in since the 1st of April 2023. And this has been brought in for a period of 3 years, and it effectively replaces the old 130% super deductions. So the 130%, the reason for that rate was if you times the 19% corporation tax rate we did have by 1.3, you get to 24.7% tax relief, which is effectively 25%, and that's now the main rate of corporation tax. So by giving full tax relief on capital expenditure for qualifying plant and machinery at 100%, effectively the same thing is carrying on. So it's at the company's marginal tax rate, which will be 25% for many of you, and it's on main pool expenditure only. So this will be movable assets. For example, it could be something like lorries, or it could be computer equipment, but also on some fixtures in buildings like alarm systems or fitted kitchens. The expenditure does have to be new and unused. So watch things like if you're buying lorries, make sure you only claim full expensing on the brand new lorries, not on second hand. And there is no limit. So this is very beneficial, and obviously can lead to a lot of tax relief being obtained in the year of expense. Although it's called full expensing, you are capitalising these amounts as normal. They will appear on your balance sheet, but it's just the fact that for tax relief purposes, you get relief in the company at 100%. There are some exclusions. These do include leasing or hiring out assets, and there are some cases where this can be judgmental. So it's well worth looking through the rules to check that you do qualify. However, there is a leasing exclusion, but if you rent a building either to a third party or another company in the group, the background plant and machinery in that building, so the normal wiring, electrics, heating systems, those are okay to claim capital allowances on as normal, and those aren't excluded by these rules. So many of you may be familiar with 50% first year allowances. These have been in since the 1st of April 2021, and we were told that they were renewed earlier this year and will continue until 2026. And again, these are for companies only, and they're for expenditure in what we call the special rate pool. So these are integral features such as electrical wiring, lighting, heating, lifts, and things like solar panels. And again, there's an unlimited amount of capital spend. The rules are very similar to those for super deductions and full expensing, but do remember it's more beneficial to use your 100% annual investment allowance, against this category of expenditure so that you get 100% tax relief in year of expenditure up to £1 million rather than only 50. So it will bring forwards your tax relief and obtain it quicker. A little recap here, because I think many of us grew up in the times of thinking that buildings and costs of things on structures no longer get tax relief since they abolished industrial and hotel buildings allowances, and those were phased out by 2011. However, for the last few years, we have had the structures and buildings allowance, and although it's only 3%, it can add up to a substantial amount of tax relief over time. For these, the timing is different. So for plant and machinery capital allowances, you claim when there's an unconditional obligation to pay. However, for structures and buildings allowances, you claim from when these are brought into use. So this may obviously be a later date than when you have to pay for them. And it only applies for expenditure incurred on or after the 29th of October 2018, provided no building contract has been signed beforehand. So this can apply to new buildings, extensions to existing buildings, and renovations to buildings that existed before that date. So it's important that most of your capital expenditure these days should qualify for tax relief. But one key important difference is that unlike plant and machinery capital allowances, this will impact on the capital gain on sale. So effectively, the 3% bring forward your tax relief, and there will be a much bigger capital gain on sale. And if you roll over, say, into another bigger business premises, you may be able to roll over and won't feel the impact at that point in time. But if you sell a building and don't reinvest into qualifying assets, you may have a substantial tax bill. So you are bringing forwards and obtaining tax relief early. And some people have said, well, if we're getting 3%, why split out qualifying plant and machinery? Well, it's important to do so because you'd get tax relief far quicker under the plant and machinery regime. And also that doesn't normally impact on the capital gain when you sell. It still forms part of the proceeds. It still forms part of your base cost. So if we move on now and just have a look at a little bit of example and try and bring those factors to life. So quite often I'll get an example along the following. My clients bought a leasehold property. They've incurred 6.75 million, and the client doesn't think they're going to get a lot of tax relief. Maybe they've identified some IT equipment, furniture and carpets. So in this example, they might have identified the 950, but other than that, they haven't overly identified too much else that qualifies for relief. So in this position, we've managed to get a further breakdown. We have the purchase price, we have the IT furniture and carpets. We also found out that they spent some money on removing asbestos. We found out that some of the amounts that they thought were building costs were actually heating, electrics and air conditioning. They actually painted the building once they bought it. They also carried out some landscaping as well as a building extension. And all of that totals up to the 6.75 million. So if we just have a little look through the types of expenditure we may be able to help with, the purchase price, if the building was built pre-October 2018, then there will be no capital allowances. You may buy it after that period, but unless the building qualified for SBAs at that point in time, there is no relief. The IT furniture and carpets will qualify in the main pool, and under full expensing, provided they're new, will get 100% tax relief. The asbestos removal will qualify for land remediation relief at 150%. Excuse me. So that will qualify for 300,000 of tax relief in the year of expenditure. With heating, air conditioning and electrics, that will qualify in the special rate pool. And I would say that it's much better to claim the annual investment allowance on that of £1 million in preference to claiming 50% first year allowances, which is another option of how the tax relief could be claimed. With repairs, we often say it's far better to put those to the profit and loss account and obtain tax relief in the year of expense. If that figure had been capitalised, then the company could only claim tax relief as that amount is depreciated, which may be not at all, or it could be over a very long period of time. With landscaping, I've assumed here the worst case scenario. Excuse me. So there'd be no tax relief under structures and buildings allowance if it wasn't required for the building extension. But the building extension itself effectively is treated like a new piece of capital expenditure, so will qualify for the structures and buildings allowance at 3%. So all in all, if we count up what expenditure we'd expect to get tax relief on in year one, that's over £2.3 million, and the client was only expecting 950,000. So that's just a small example of how we can help to identify and maximise a capital allowance claim. And I won't go through the next table of rates, but quite often people say, well, how do I know where to start when I have a choice of claiming different allowance rates? So I'll just chat through a few of these on the slide, and they start from the highest tax relief at the top. One that can often be missed is land remediation relief, and this is available to companies only, and it's available to developers or to investors or to people that obviously trade out of their own businesses. So things like asbestos, Japanese knotweed removal, or removing substructures under land that's been obsolete for a number of years, they can all get 150% deduction. So spend £100,000 and you get £150,000 taken off your tax bill. We've already briefly talked about the super deduction and the full expensing that replaced it. And don't forget the annual investment allowance. It is limited to £1 million, and that has now continued and will remain at that amount on a permanent level, which was confirmed to apply from April. Previously, the 1 million was known as a non-permanent limit, but it had been there for a number of years. And with the annual investment allowance, it's normally preferable to claim that over and above the 50% first year allowance, or even the 100% full expensing. And many people say, well, why make the difference? But actually, when you come to sell the asset, if you've claimed full expensing, then any proceeds for the sale will automatically be taxable and taken to taxable profits. Whereas if a company claims the annual investment allowance, when that asset is sold, then actually those proceeds will get set against your main pool, which may still have some tax value left in it. So you may slow down further tax relief rather than giving the company an immediate tax charge. So there's quite a few things to think about when deciding how you'd like to claim relief. There's now more limited 100% first year allowances, but don't forget this on things like new and unused cars with no CO2 emissions, electric cars, or electric vehicle charging points. And moving on to the next slide, don't forget things like R&D capital allowances if you've got a building, for example, used in R&D. Moving down through, if you've got further tax relief, you can still get writing down allowances on your main pool or your special rate pool, but these will only be at 18 or 6%. And finally, the slowest form of tax relief is the structures and buildings allowance, but that's normally on a very substantial number, so it's well and worth banking that tax relief. And just finally now moving on to some pitfalls and opportunities. There are fixtures elections if you're buying or selling property. So things that are permanently attached to the building, you have to agree with the purchaser or seller what figure will be fixed to those, and there's a strict 2-year time limit for submitting that election to the revenue. If you're selling and you haven't made that election and you have claimed allowances, there'll be a market value clawback. So it's really important to get this right. So planning is really key. If you're buying or selling, it's important to plan early. Also, if you're purchasing property or if you're going to be making a claim and there could be a sale, for example, at any point, making sure that everything stacks up and has backing papers and reasons for decision is really important for due diligence in any future sale. Don't forget that SBA's structures and buildings allowances do impact on capital gains when sold. but it's much better to get tax relief as you go along than to wait for an eventual sale that may never come. And do take care when these items are sold. We have had a lot of different regimes over the last few years, and the pot of expenditure that's put in does depend on the tax relief on the sale and how any proceeds will be actually treated. So, for example, if you claimed a super deduction for expenditure incurred in 2022, if you now sell that item, then those proceeds, limited to the original cost, will need to be times by 1.3 and that amount taken straight to taxable profits. Again, if you've had full expensing, any proceeds are taken straight to taxable profits. And if you've claimed 50% first year allowances, when you come to sell, half of the proceeds will go straight to taxable profits and half will then go to your special rate pool. So it is a case of needing to know where items were put to start with and a need for strong linking records between your tax computations and fixed assets to have that understanding. And don't forget to use your annual investment allowance and understand the link of that and how important that might be if you get proceeds from a sale. And finally, just a few other opportunities to look out for. There are free ports and investment zones that have been identified across the country where there are some beneficial tax reliefs available to businesses. In the southwest, we have an area in Plymouth covering Langage, Sherford and South Yard. And again, in the Solent, there are also areas that qualify as a free port. And the benefit of that is the fact there's 100% potential capital allowance on expenditure in those areas. Do look out if you're purchasing commercial properties or a furnished holiday let. Negotiations are very important. Often people agree a price without understanding what tax reliefs will be available. And actually understanding that may help form part of the decision of how much you wish to offer. There's something called the Commercial Property Standard Inquiry Responses, which are very important to get advice upon and understand in order to ascertain what tax relief will be achieved. There's some very important elections, in particular in relation to fixtures that need to be considered and also agreed at that time. And also, even if you do have an election, if you're purchasing a property, there can sometimes be opportunities to claim further tax relief. Due to a rule change in 2008, some electrical items like general electric, general lighting, the previous owner may not have been able to claim, but actually you may be able to claim depending on the date those expenditures was incurred. So even if you have an election, there may still be opportunities to get further tax relief. So it really is worth getting tax advice on any property purchase. And finally, some of you may say, well, we haven't got transactions, we've just got property and we've owned it a number of years. But have all the allowances been claimed? It's remarkable the number of clients we speak to where historically they assume this is the case, but actually we've been able to uncover further tax relief, and provided those assets are still in existence, then it's still possible to make a tax claim, which can lead to amounts to deduct from taxable profits, or even losses to carry back and generate some well-needed cash for the business. So hopefully that's been a useful update. We've covered quite a number of areas today, including the 2023 changes, some pitfalls and some other opportunities. But if you'd like to get in touch, please feel free to get in touch with Heather Britton and I'd be happy to help.